And with that introduction, we will get into the main content of today's webinar, which is looking at the solar landscape into 2021 and beyond into 2022 and 2023 in some regards. First, we want to highlight where different stages of production are throughout the entire value chain, and especially how these different production stages relate to the end downstream demand measured here by installations. As you can see from the left-hand chart, we have an increasing amount of production capacity as we move downstream from polysilicon all the way to module production. And then the significant gap between your first upstage raw material refinement in polysilicon production and then the final manufacturing capacity for modules is creating a significant disconnect between what manufacturers would like to produce and what the industry is actually able to supply in terms of components and equipment. And the sudden expansion on the module side, as quickly followed by the cell side, is leading to an even tighter mismatch between upstream production stages and the final demand from end users. And as we're seeing more module makers continue to demand more cells and cell makers continue to demand more wafers and wafer producers all vying for limited amounts of polysilicon production this year, we're seeing prices increase at every stage of the value chain and additional costs being passed on to consumers. And even as projected installations are starting to now tend towards the conservative side, in that some buyers are anticipating they may hold off on projects in 2021 due to higher pricing, the downstream or the upstream segments can't not always necessarily afford to pass on the full amount of cost increases to buyers. They are reducing margins, but they continue to produce large amounts of product just to keep factories running and to keep their utilization rates at above a bare bones level. And so we'll go throughout each one of these stages in a little bit more detail and figure out where bottlenecks are developing and when bottlenecks are expected to start alleviating. First, we want to focus on polysilicon. Polysilicon became a major topic of concern towards mid to late last year when a series of accidents at major polysilicon production facilities highlighted the vulnerability of this upstream stage of production. Polysilicon supplies had been becoming more constrained over time. As prices had been falling, low-cost Chinese production started crowding out other sources of European, American, and other non-China Asia production, forcing those producers out of the market and really condensing polysilicon producers to a few major suppliers. The narrowing of that polysilicon production chain really hit the forefront of news when all of a sudden a huge shock to demand born out of those accidents at some other polysilicon facilities really focused attention on how tight the supply and demand had become for polysilicon. And even though the result of these accidents was that polysilicon producers realized some expansion would be needed in order to sustain downstream production, and suppliers all throughout the solar production supply chain realized they needed to be more cognizant of this upstream sector. The reality is polysilicon is a very timely, new polysilicon production is a very timely process, time-intensive process. And even though construction on new facilities has begun, it's not really expected to come online in any sort of meaningful capacity until very late into 2021, but more likely into 2022 after next year's Chinese New Year. What that means then for prices is that on average, prices will continue to rise over the course of this year, culminating in anticipated high points in Q3, right ahead of the expected end-of-year rush in the Chinese domestic market, as well as some last-minute buying from overseas markets as well. The indicative prices given here are current projections, but we've seen continued price volatility in polysilicon, and we are likely to see high prices much higher than the $22 per kg mark we're forecasting in Q3. And there's also the opportunity that pricing could be slightly lower than these forecasted amounts if additional production can come online from mothballed facilities that are not yet included in our pricing outlook. What this does mean, though, is that even as pricing for polysilicon is expected to decline into Q4, pricing for downstream components, including modules, will continue to remain high. Even though polysilicon takes about a month to transition from an upstream production stage all the way to your final module product, wafer makers are cognizant that the upstream prices are continuing to rise and are expected to continue to rise. And as additional wafer production is taking place, wafer producers continue to buy polysilicon and stockpile either the raw material or going ahead producing wafers and stockpiling those wafers in anticipation of Q3 and Q4 when demand is really expected to come to the forefront, no matter if prices continue to increase. What this means then is even as some upstream prices might start to fall in Q4, your final finished module price will still be going through inventories of the higher input wafers and cells and polysilicon that is being stockpiled now. Polysilicon and wafers can last about 1 year in inventory, so there's no worry on the part of wafer suppliers or polysilicon suppliers that if they were to produce now, they will not be able to use their product later on. Cell suppliers are in a slightly more uncomfortable position in that wafers need to be used as soon as possible after processing from a wafer to cell takes place. So we're actually seeing cell margins squeeze the tightest in the industry as cell producers have realized that they either need to hold off on producing cells or just stockpile wafers now and go ahead and do cell production as module demand needs those additional cells. But no matter the case, we are expecting that module pricing will continue to remain flat or higher throughout the year, even as there may be a Q4 dip in polysilicon pricing starting to trickle down into other segments. And turning beyond 2021, there is a significant amount of new polysilicon production on the horizon. Again, not a lot of this new production capacity will come online this year. A very small amount will come online on the part of Tongwei very late in Q4. But a majority of all the expansions which were started at the end of last year, early this year, are slated to come online early to mid 2022. And that is when we expect that polysilicon is likely to be put more on a downward trajectory and we'll start to get more reasonable polysilicon pricing. That's not to say that polysilicon pricing will crash to the levels that we witnessed in mid-2020 at the height of the COVID pandemic and the height of uncertainty in future solar demand, but we should see more temperate pricing in addition to more reasonable prices for other components along the solar value chain. It's also worth noting that a lot of major expansions are still being undertaken by the big 5 producers of GCL, Tongwei, Shinta, Daqo, and East Hope. These 5 producers really do have a dominance in the industry, and they are the only suppliers that are really confident and able to undertake sizable polysilicon expansions at this time. It's also worth noting that many polysilicon suppliers are also diversifying their production locations, moving new production into Inner Mongolia, which is also expected to be a source of low-cost polysilicon production, or moving polysilicon production into areas like Yunnan in the case of Tongwei to take advantage of hydropower in polysilicon production in anticipation that more carbon footprint requirements will start to be placed and come into force in the solar industry. And again, it's worth repeating that even though there's very sizable polysilicon expansions on the horizon, it will take time for these polysilicon facilities to come online, ramp up, and the new material that they start to output to finally start flowing through the solar supply chains. And polysilicon price declines are expected to be moderated until mid to end 2022.